Hey guys, this is Edward, and for today, it's a bit late. Sorry about that, but here's my lesson for today. Today we're going to be talking about futures. So I'm going to explain the basic concept around the futures and the futures market. Okay, so our first thing, as always, is our futures definition. And so as you can see with this graphic, it says that a futures contract is just an agreement to buy or sell a commodity for a specific price at a future date. And it makes the buyer or the seller buy or sell the asset at a set date and at a set time. And that's basically it. And yeah, as I said before, it can work both ways. So it can be a set price to buy something, or it can be a set price to sell something. And so basically, in the futures market, there are um, two types of futures contracts that you can see. So there is the financial features. So that's like, yeah, as you can see here, the stock indexes, currency markets, interest rate products, and then there are the physical features. So you can uh, hedge your bets, which I'll cover on later in the video, where you have your energy markets like oil, natural gas, but you also have agriculture like corn, wheat, stuff like that. You have metals like gold, and you have like softs. So those are the two basic types of future contracts. Contracts. I'm sorry. Yeah. So to give a few more examples, you also have the stock indexes, such as I've talked about in a previous video, the S&P 500. You have currency markets like the American dollar or the Japanese yen. I'm pretty sure. Yeah, Japanese yen. And you have bonds, bond markets like treasury funds, all those things. They can all be different types of features. And so, for those of you who know what options are, you might be wondering what the difference is between futures and options because both of them, you are kind of making an agreement with someone to buy something at a certain price in the future. But as you can see in this graph here, in the futures, you have to buy at a certain price at a later date. You cannot back out. It is non-cancelable. But in options, you just have the right to buy at a certain price later down the line. You are not obligated to fulfill and buy it at that price. And the futures, you're basically once you make the buy or the sell call, and once you buy that futures contract, you basically bought it, and it is in your portfolio. So, say for example, you buy a futures contract worth like $50 in December, and you buy 1,000. Okay, you basically have $50,000 worth of the futures contract in your portfolio. But in the options, you can buy it anytime before the expiration date, and you don't even have to buy it at all if you don't want to. And in the futures contract, there's unlimited profit or loss. But for the options, it is only risk limited to the premium paid for that right to buy at a certain price. And so, yeah, I know some of that stuff might be a little confusing for people who don't know what options are, and I might do that in a later video if you guys want. But for those that do know, that's just the difference between the two. And so now we want to talk about the advantages and disadvantages of futures. And so you can see here that futures, they take advantage of leverage, and they usually have high leverage. And what leverage is just means that you do not have to pay 100% of your position size. You can just put in a minimum, and then your broker may let you borrow money and amplify your buying power of your cash. So they use a lot of margin. So yeah, there's less upfront capital that you need to provide to get into a position. But the disadvantages of margin, and not just for futures, but for really any type of asset or yeah, any type of asset that uses margin is that it can amplify losses. But on the plus side, it can also amplify your profits. So you really have to be careful when you're using margin and you're using high leverage. And so as I said before, it has unlimited profits, so it can really go sky high, or it can have unlimited loss, so you can hit rock bottom. And another advantage is, as I said before, you can hedge your bets. So basically, you can lock in a safe price. So, for example, many companies will often use futures to lock in a price to sell something. So that means they know that they're making profit at that point, so they can just lock in that sale, and then they won't have to be adversely. Oh, sorry, I think I just touched the mic. But they won't have to be adversely affected by any down shifts in the price. So they can lock in their price for companies to buy or sell and basically assure themselves a profit. But the disadvantage is that because it's non-cancelable, as you can see in the next disadvantage, they can often lose out on profitable price swings. So, for example, if they locked in a price of $50, but then maybe they're uh, supplying oil, and then the price of oil shoots to $100, they still have to sell at $50. So they lose out on that whole entire $50 of potential profit. And the last advantage is that it's easy entry, but and then, as I said before, non-cancelable as a disadvantage. So now I want to go into a few examples of how futures are used. And so I'm going to first talk about how companies use futures. And so, as I said before, companies often use these futures to set their buy and sell prices for physical products and therefore make sure that they can have a safe price to buy and sell, assuring themselves that they will at least have some kind of profit and that they don't have to risk it in a very highly volatile field where prices may go up and down on a whim's notice. So let's say, for example, there's this oil company and they dig oil up from the ground and then they sell it to whoever, right? And say, for example, they don't want to take part of the volatile market of the oil prices. They don't want to, maybe one day oil prices go all the way to 20, or they feel that, maybe oil is not at a very good position right now and that they feel that the price is going to go down in the future. So they buy a October contract for $100 to sell. And I want to explain the October contract. So basically, I said before that contracts have expiration dates, and the contracts are renewed every month. So there is a contract for each month, and that is just basically the expiration date at which they must fulfill their contract order. So they buy an October contract, meaning that they must sell at the $100 in October. And let's just say the current price of oil is $100. September comes around, and they were right. The price of oil is going down. It is now $90. And now October comes around. The contract expires, and the company must sell. And the current price of oil is $80, but because they have that contract, they can sell at $100. And so their profit is $20 more per barrel than the market price and there, they got made a profit. And it can also work the other way with traders. Traders can also speculate on prices through the futures market. And so crude oil is a has a feature as well, which is I think backslash CL. If you want to look that up, that's one of the crude oil futures. And so this is another example of how traders this is an example of a loss through the futures market. So say, for example, that in January, he enters a May contract at $75, meaning he must sell, he must buy, I believe, at $75 in May. And the current crude oil price is $70. And so in February, things are looking good. Crude oil prices are increasing, so now it's $75. And then in March, it becomes $80. But suddenly, this trader made a mistake, and crude oil prices tank. And now it's going to 70 in April, and then 65 in May, where he must buy at. So now he has a worthless, basically, contract where he loses money. So he has $65 of the current price, and then minus the $75 contract that he bought at, so it's minus $10. And then because crude oil is bought in thousands of barrels, he just lost $10,000. And so that's kind of basically the futures market and how companies and traders alike use the futures market to hedge their bets, to make money, all that kind of stuff. So if you have any questions about the futures market, please drop them down in the comments below and I'll try to get to it. And if you like this video, please leave a like. And if you like the videos that I have on my channel, then please subscribe. Anyways, that's all there is for me today. So thanks. Bye.